Thanks everyone for staying. I think this is actually going to be the best session and the last and best session of the day. So I'm Fiona, and I'm really, really happy to have three actually Hong Kong-born, really great entrepreneurs who went through the tough experience of entrepreneurship and actually achieved really great exits. I'm going to do a quick introduction. Alfred is the managing partner of Raise Capital, and he co-founded BEA Systems and led it to an 8.6 billion acquisition by Oracle. And he has the title of Silicon Valley CEO from Andreessen Horowitz. So thank you, Alfred, for joining us today. Next, we have Alan, who is a 3-time entrepreneur with 2 exits under his belt. He is probably most well known as the co-founder of Wattpad, which is the world's largest social storytelling company with over 100 million monthly users, which sold to Naver for 660 million in 2021. And he is also right now the co-founder of Two Small Fish Ventures, a deep tech VC investing in the forefront of technology. Welcome, Alan. And last but not least, we have Arthur with us today, who is the CEO and co-founder of 6waves, a global leader in online gaming. His 6waves is a leading global publisher of Facebook games, reaching over 20 million active users to 20 million active users across 150 games. So the company had achieved a successful exit in the social gaming boom, and Arthur is actually currently still an executive at 6waves. So we have 3 really amazing panelists here, and I'm going to jump right into the question. So the first part I want to dive into is what made your exit successful? And what do you think, was there a specific move in your journey, or there were some critical factors that paved the way for your exit? So maybe we start with Alfred.
I think in my situation, I actually didn't want to exit. BA was a great company. It was the year that we sold the company in 2008, its revenue was about $1.7 billion. It was still growing about 30% per annum, generating about $500 million free cash flow. No debt, tons of cash, but we had somebody had been in love with the company, wanted to buy it almost from the beginning. That was Larry Ellison. And at some point, I think for me, the decision comes down to is once you go public, it really wasn't my company anymore. It was a shareholders' company. And when you had a financial crisis in 2008, you know, like the choice of taking the cash offer versus not doing it would have been a sin. So I had to do what the shareholder wanted. It was a terrific exit. At the end, Oracle paid $1 billion more than the price that they started with, but it was tons of drama. You know, so if I go back, I would have loved to continue to run the company. It probably will be a lot bigger and doing a lot of exciting things in the world of AI today.
Yeah. Well, somewhat similar situation. I would say the best exit strategy is, guess what? Not having one. Because at the time of around the time of the acquisition, we were a venture-backed company. So as you probably could guess, we had to raise a lot of capital, drive growth, and get to the point when we had 100 million users. And but at that point, we were kind of self-sustaining already. In a way, we have all the optionality in front of us. At the time of the acquisition in 2021, we could continue. We could raise perhaps more growth capital to drive more growth. We could potentially sell the company, and we were considering IPO as well. So all 4 options were in front of us, and an inbound offer came in, and we leveraged that to run the process, and then the rest is history. So in a way, we similar to BEA, we did not plan to sell, but once the opportunity comes along, you leverage the situation, you leverage the circumstances, and drive the outcome that we all want to see.
Right, and for me, we founded the company in Hong Kong, but our users are over the world. But for the initial years, we never thought about an exit. It's about survival, right? You just want to make sure that you know, your proof of concept is going to work, it's going to be profitable and sustainable. And then we really start thinking about an exit is when we start to raise our first round. Once you have external investor, then you have a mandate somehow to get an exit, pretty much for them rather than for yourself. So I think that's where we start to think about an exit. And I think your question was about how do you get a successful exit. I think ultimately you have to make yourself attractive to potential acquirers. So for us, we're based in Asia. We have a lot of users in Japan, Taiwan, and Hong Kong. So instead of talking to companies in this area, we've been focusing on talking to potential acquirers in Europe and in America, because we are going to be very complementary to what they do. And overnight, if they acquire us, then they could actually expand tremendously in terms of their global reach. So I think you also have to find potential kind of good acquirers and make yourself a lot more attractive to them. So you have to be very targeted in who to talk to.
So let me follow up a little bit on Arthur's response. So were you, I think for Alfred and Alan, you were not actually going out for an acquisition. You were just building a great business, and then circumstances you had to sell, right? But Arthur, were you actually looking for potential partners that would be potential acquirers during your journey?
I think we were a little bit open. I think one thing that the co-founders were quite sure is that we don't want an IPO. I think it's very similar, right? So once you get an IPO, you don't really get an exit. You kind of tie down for a long, long time. And also, it's no longer your company. So one thing we thought that we either stay private or we do a trade sale. And for that, yeah, I mean, we're looking for potential partners that we've been working along for a long time, or people in the industry that we feel there's a lot of synergy that we can potentially kind of partner for a longer time. So yeah.
And I guess Alan, the neighbor that you sold to wasn't probably not the first acquirer that came knocking on the door. So how do you know that this was the right one?
It's in a way circumstantial. As I mentioned, we were not really thinking. We were thinking about all the different options ahead of us, and then an inbound offer from another company came in, and we leveraged that to run the process. And I think this is an important point because we had the optionality. We had we can choose. We can walk away if the deal is not attractive enough. And I distinctly remember one conversation with one of the potential acquirers. I think your price is too low, right? We could consider IPO, and if we IPO, the market cap probably would be double what you are writing on the term sheet right now. So if you want a good deal, you need to have that optionality and have the ability to walk away if the terms are really terrible. I think that's the key to drive a successful exit.
And the second part of my question, it's about more strategy and practical steps. So as I was an entrepreneur myself. I am still an entrepreneur. And investors, when you go fundraise, they love to ask you, so what is your exit strategy? That is a question, and I'm sure everyone would say, yes, we should focus on building the product and just building a great business, which I think it's, of course, very much true. So, for many founder friends down there, if investors do come and ask, what do you think about your exit strategy? What is your advice to founders when they get approached with this question?
Well, the best exit strategy is when you're not planning for an exit. So when something is not for sale, the buyers will have to pay up. So there's no doubt in my mind, by the way, there's no reason to start a company if you don't think you're going to take it all the way. And take it all the way have many different forms. It could take it public. It can remain private. It actually, at the end, at the right circumstances, you can merge with someone. You can be acquired. But I think I will never ask my own founder, what is your exit strategy? That exit strategy should, by and large, be designed as a natural course of building the company. And your investors should be part of the journey with you, right? So if you want to have a company that's you're going to be building up for a long time, you should have investors that have that kind of staying power. Otherwise, it's going to be miserable. But I will never plan for exit. The exit should come to you. That will be the best type of exit.
Yeah, well, similar to what Alfred said, I think I can share my own experience as an entrepreneur. We were venture backed, and you might think many of our investors would ask us, when are you going to exit? What's the plan? In fact, it's the exact opposite. I think I would say most of our major investors are exactly opposite to that. So I would say, as a venture-backed CEO for 10 years, in the first 9 years, we never talk about exit. And by year 9, I was the one raising the question. Board members, it's been almost a decade. We never talk about exit. And guess what? Before I could even finish the sentence, one of the board members interrupted me. Alan, I just want you to build a great business. Let's not talk about exit. I think it's very, very unusual, but it actually worked out. So now I'm sitting on the other side of the table. I'm looking at new investments, investing in mostly C-stage companies. There's one ask to the entrepreneurs. If you pitch to us, take out the exit strategy slide. We don't want to see it. If you have an exit strategy slide, here is the exit. Thank you.
Alan, actually, well said. Alan, actually, I want to add, BA was almost entirely funded by a single venture firm. It was Warburg Pincus. Warburg gave us about $50 million during this journey. And Bill Janeway, who is my mentor, was on the board the whole time. He never asked once. In fact, he was the first to object the sale of BEA. By then, he already got $8 billion worth of return for his fund, right? But they still own a bunch of shares. So I think great investors will have visions that kind of align with the potential of the company. It really should be aligned with that. Instead, it should be aligned with the money.
But just want to add, I mean, there are still venture capitals and investors who are looking for an exit. So you have to be careful who do you choose to. But if you're looking for a round, you talk to these people. This seems to be nice guys. They're not really pushing you for an exit.
Then Arthur, how did you deal with that?
No, so I think, if they ask me, I would just say, my exit strategy is to, I have like as many options as possible, right? You don't want to be forced to an exit. And how can you have more options? Is that if you build a very successful and sustainable defensive business, then, you can do whatever you want. You can stay private and you can pay out dividends, or you can go for IPO, or you can do a trade sale. So as long as you have a very sound business, then, you don't have to really answer that exit question.
I think that's really, really good advice. And I want to add that funds that are started by entrepreneurs and people who have operated businesses are very, very different than pure financial backed VCs, right? I think the profile of the talent is just very, very different. And I think Arthur gave a great point on how to deflect that question. Yeah. Sorry, Alan.
Just want to add, if you have a 4-year-old kid, are you going to ask that 4-year-old kid when he or she becomes 25-year-old, what job are you going to apply for? It's a very, very silly question, right?
My wife does it to my son, so.
Okay.
Sorry. Is it recorded?
Most parents,
no? Hope it's not live.
Most parents would think about this, but be very, very specific about what job you are going to apply for. At 25-year-old or 30-year-old would be crazy. So why would you ask a C-stage company when there are only 2 founders and nothing else? Where are you going to, which company you want to sell to? I think it just doesn't make sense.
Yeah, I think that's a great analogy. And I think a lot of schools, ask a lot of children, like, oh, what do you want to be when you grow up? It's actually the same problem, right? It's a very stupid question in a way.
What you want to be is okay. But which job you want to apply to, which school you want to apply to, that's a little bit too much.
Okay, so let's say, back to the topic of there is a potential acquirer knocking on your door, right? And I think that for a lot of entrepreneurs, that's actually a happy problem to have, let's say. But what are the top 3 things you think that the founder should do, right when that happens?
Well, there's no doubt, by the way. Number 1, call your general counsel. because any offer, you have obligation to review it along with your board. Because remember, it's a shareholders company. If you don't own 100% of the company, you must review that with your shareholders. So first, contact your general counsel. Number two, you must contact your board. So this is not an offer to you, it's an offer to the company, so your board has to review the offer. I tell you, the third person I call my mom, right? So of course you call your mom. Why wouldn't you call your mom, right? Everything in my life I call my mom. Of course I call her. Well, unfortunately she didn't give the answer I want. She said, oh my, I got 8.6 billion, of course you should take it. Yeah, right, so.
I did not call my mom. I call my wife. But joking aside, yeah, you're absolutely right. I did not talk to the general counsel first, but I talked to my board first when I got the first offer. That first offer was terrible, I have to say. But as I mentioned, we kind of leveraged that to run the process. So with the board, green light, we start to interview a banker, find the best banker in that situation, and then ran a proper process. And I think that's, I want to highlight this. Sometimes, I'm not saying you have to use a banker or you don't have to use a banker. You can always find good examples in either case. But in our situation, I can speak from my own experience because we want to leverage that offer and see what other people would buy us for. And to properly run that process, it's actually very, very hard for the CEO to do it himself or herself. So having someone as a filter to run that process for you in a way, it's a bidding process, right? And that actually allow us to extract almost like the maximum value out of the whole situation. I guess it's very circumstantial, depends on your situation, but if you are thinking about if your situation perhaps justify a bidding process, having a banker to help you out actually quite important.
So Alan, actually just to add to that, kidding aside about my mom, I still ask my mom first, but nevertheless, actually in my situation, the acquirer, which is Oracle, wanted the company so bad. We said no so many times. We first had Chow, which is a very well-known activist, that bought 9% of the company without announcing it. So the first time I saw it was somebody called me up in the middle of the night and said, you should turn on CNBC now. He said, who's on TV? I said, you're on TV. And he was running a tape. I said, oh, I didn't say any of that stuff. It doesn't matter. So then you need a crisis communication firm to kind of fight it. And then you need a very good lawyer, different kind of lawyer. In our case, you need a Workduo Lipton type of lawyer to kind of fight off, this raid of the company because they're trying to throw everybody off the board. Then the deal went from friendly to hostile. It's very rare in tech that you actually have a hostile deal. So that 12 months, along with Goldman Sachs as the banker, it was a complex process to negotiate, to make it friendly, and me being romance, got into Larry Ellison's yard, his house, and all that kind of stuff, and trying to make peace out of the deal to make it the best for everybody, and then we face a financial crisis. So I think each time when these kind of things happen, you don't know. But I really believe that good CEO should be able to handle crisis really well. You should never be comfortable when things are good, right? And if things are bad, it should be normal. I know this is very difficult to accept, but that would be the advice I would give to every single CEO. If you like this job, the people that grade this job is to be able to handle the crisis. There's never no crisis. So, I mean, I saw a big crisis, but at the end, it blow over, So you look back, oh, it happened. It's no big deal,
Oh, so yeah, the first three things that I'll do, if there's like a potential acquire, is like what a lot of YouTubers say CLS, but for me C is compare, similar to your thought, right? So you don't just get too excited with the first term sheet that you got and just dive into it, right? You talk to other potential acquirers, and what we did was is a kind of like hybrid. We talked to a lot of potential acquirers that we already have direct connection, but we also use a banker to talk to someone else that we might not have a potential connection, and try to get the best deal out of it. L is learn. learn about your potential acquirers. So your investor will just say, pick the best, highest number, right? Because they want the best return of their investment. But you're going to be working with the potential acquirer for a longer term, right? Be it you may exit in a very short term, but your teams probably will stay and work with your potential acquirer for a longer term. So you want to make sure that you can actually work with them in a nice way. So learn about your potential acquirers. And then S, for me, is the share of responsibilities. Because during the whole process, it's very demanding. And as a CEO, you cannot do it all. You have to share your responsibilities, divide and conquer. The due diligence on tax, on your HR, your IT and finance, it's very, very taxing. So you need your team to step up, and you have to empower them to cover different parts of the company, because otherwise you cannot handle the whole process.
Right, and I just want to add my little 2 cents is from my own experience, you don't get a term sheet on the first day, right? There's like a period before, and sometimes there are fake acquirers, right? That they're not actually here to acquire your business. They're wanting to learn more about you. If I've heard it from a lot of startup friends that this has happened. So that is probably a pitfall to avoid. Don't overinvest in when someone says they're interested in potentially acquiring your company, and send their corp dev team to talk to you. Okay, the last part I want to talk a bit about is a trickier one. Obviously, you guys are hugely successful, and it's easy to forget that actually 90% of startups do fail or do plateau. And not every company is destined for an IPO or even an M&A billion-dollar exit. So I guess I want to ask all 3 panelists, what is your advice to founders to know, when it is to push forward? When is it time to pivot or just avoid growing at all costs? I know a lot of founder friends are in that threshold, or maybe they even have trouble raising venture capital funding. So what is your advice generally to that?
Fiona, that's a great question. In tech, there's no such thing as a non-growth company. When you're not growing, that's death. It doesn't matter how big the number is. When you stop growing, the company almost will have nothing. So we don't have a choice. The market only rewards us by growth, which trumps everything else. You see the Woods deal now being sold to Google. Look at that kind of current year revenue multiple. It's all because they said they're going to grow from $500 million to $1 billion next year, right? Databricks at $2.5 billion in revenue, they raised around a $62 billion post. People get that kind of valuation is not because of just their size. It really has to do with growth. Because growth is what people want. Why would people buy you? Is because they want growth. So whenever, by the way, I ask people a lot of times, they say, well, do you know why stock option vests in 4 years? Why did some random Palo Alto lawyer decided that options going to be vested 4 years? Because that generally is the terminal limit of a single spur of growth. At the end of the 4 years, generally companies that don't do a new thing, they will stop growing. So as good leader, our job is always think about growing. And if that part of the process that require a major left hand, which we normally call pivot, let be it. So most of the investors, especially the early investors, will not be allergic to people that want to pivot. Why get stuck? Stuck is no fun. Our job is to grow the thing, right? So I don't think we should be thinking about whether, well, we should just sit on it. It's a cash cow. There's no such thing as cash cow in our business because they will be bought for nothing. Oh, don't do that, yeah.
I guess the harsh reality is maybe 80% or even 90% of the company would not be a breakout success. And if it becomes, if it doesn't work out, you shut down the company. That's actually easy. The worst type of decisions or situation for the founders actually is when the company are doing okay, it's not growing, it's kind of flat line, you kind of get stuck. There's a term for it, it's called zombie company. I'm sure some of you have heard of that. In that type of situation is the toughest. I don't think you can simply generalize. For some founders, it's their life work. they would never give up. They would rather die with the company in 20 years, 30 years from now. And for some, they lost the motivation. They might have to move on because they just cannot wake up in the morning and work on and look at the computer and work on the company anymore. So I think for that type of situation, at the end of the day, it's a very, very personal decision. Even though you can look at the numbers, the spreadsheet would tell you a lot of things, but ultimately, this is your baby. You spend maybe 5 years or 10 years, for some of them even longer, 15 years on it, and the result is perhaps nothing. What are you going to do? Are you going to give up? Are you going to walk away? Are you going to find someone to take over? I wish I have an answer for everyone. I wish I have a playbook, but at the end of the day, it's a very, very personal choice. I don't think anyone can give you advice because you, as a founder, you have to make that decision.
So I guess in terms of pivot, typically I think usually there are two possibilities, right? One is like your current route is not working anymore, right? And the other is like, there's a better way of doing business while you're actually doing fine. So for us, when we started the company 16 years ago on Facebook, we actually did advertising first. So it's doing well. I mean, we got our cash flow in, right? But then we realized people actually pay a lot of money to play games on Facebook. Then we pivot to do social games on Facebook. So that's one of the possibilities where we find a better way. And then eventually we started to think, hey, Facebook games are dying. So we have to pivot again. So we now do mobile games, right? So I think you kind of like, you actually have some clear signals about when you need to pivot, as long as you're being observant and not just focusing on what you're doing all the time. So just make sure you still like talk to people and see what's going on out there.
Well, I think one of the things that I think is crucial is sometimes when you get stuck, it's normal, by the way, because you're passionate about what you do, which is also the reason why good entrepreneurs should have advisors and really good investors around you. They're supposed to remind you. It kind of looks stuck, my friend, so you may, we'll give you suggestions. So they're not supposed to give you the answer. You're the founder, you're supposed to come up with the answer. But it's be good for people to remind you, to have the discussion, to be open with you, to be direct with you, to be blunt with you. So those advices are very hard to find. Whatever form that comes in, whether they're board members, they're investors, or they're friends, or they're people that you have worked with in the past, get some. It's very hard to do this alone. Co-founders are excellent ideas. So I rarely found, like fund companies with no single founder anymore for that reason. It's good to have, more minds looking at the same problem.
Yeah, I think that's a great segue to actually my last question for all three of you. I think that the entrepreneurship journey, exit or not, is very, very tough mentally and psychologically speaking. So what piece of advice would you have for our founders where it really helps them? Because I'm sure it's not all high up here, right? A lot of times you're like here, like everything sucks, right? What did you do personally to get through that?
I have to be honest. I think I personally committed a mortal sin. When BE got sold, I ran it for 44 quarters as a public company, in total about 15 years. And I was so into this thing, that was my life. So when I woke up one morning, I was in my early 40s, I said, oh my God, now what do I do? So I immediately, without thinking, went and started another one. I should have never, ever have done that. I should have taken a deep breath. A lot of people, my own advisor told me, say, you should probably take a year off, right? And when you're burnt out, you cannot tell because you're so into it. So I would say, I didn't do well on that one myself. If I would do it all over again, I would have taken that advice, and take it to heart and really have a reset in my head and say, hey, that was the end of the chapter. I need to move on to a new chapter.
I guess I wish someone told me it was that stressful in the beginning. I didn't realize it was so stressful. But now, after selling my last one, if you check out my LinkedIn profile, you see I say recovering CEO. I think I should change that to forever recovering. Well, joking aside, I think one advice I wish someone would tell me is you just have to be unrecognizable every 2 years because you're running a fast-paced, high-growth company, and every year or two, if you are not growing fast enough, you'll be left behind by your own company. And that's why it's so stressful because every time I thought I figured out I'm a good CEO, I'm doing my job, and 6 months later, everything is broken. I wonder why, and it's not because I wasn't doing my job, it's because the company is actually drastically different than 6 months or 12 months ago. And I have to keep up, and I wish someone told me earlier, because I have to figure this out. Okay, I have to be a perpetual self-growth machine for so long, and figure that out. It took me a few years. I probably would have, the company would have done better if someone told me this.
Yeah, totally agree. It's very stressful, but I would say it's a very also rewarding. I think if I could actually start it again, I would start it earlier because it's very, very draining. The younger you start, it's actually better. So yeah, I think if anything, my advice is just hang in there. Yeah, just believe in yourself.
Okay, I think that ends on a great note. Thank you to our 3 panelists, and thank you to you all. And have a good evening.